Anton, thank you so much for having me. I'm excited to chat today. So I am the owner of Shine Insurance Agency, but really before anything else, I'm a teacher. So I was an elementary school teacher for 13 years. I taught in third and fourth graders how to do math, how to read, how to write, how to play soccer, how to play hockey. We played a lot of hockey, actually. It was one of my favorites. So I spent a lot of time being a teacher. During that time, I met my wife and business partner, who is a third generation insurance advisor, and she was running her dad's agency. And we just saw a lot of potential in this space. We saw a lot of sort of old boys club stuff. We saw a lot of problematic behavior in the insurance world, as so many of us know. I mean, insurance just has this reputation, just the word. We kind of, feel struggles with it. I think all of us do. And so we were both ready to do something different. And we thought, what if we try and change the way people feel about insurance by simply being educators and trying to be good people in the space? And so we started Shine in 2013. I fell in love with real estate immediately. So I was working with first-time home buyers when I first started and just teaching them about how to get a mortgage, how to fix their credit, what an inspection was, what an escrow period was, what a title company was, what closings were, all these kinds of things. I was just teaching first-time home buyers how it all worked. And I was doing that mostly by asking realtors and lenders and everybody else how it worked. I started making videos on YouTube, and those videos just started getting a lot of views. So we now have about 14,000 subscribers on a YouTube channel. And teaching first-time homebuyers led into teaching people how to invest in real estate in general, which led into really commercial real estate investing. And now I am 100% not only on the insurance side, but on the YouTube channel, all around commercial real estate, teaching people how to succeed in this business, how to build a strategy that makes them lots of money and takes great care of people at the same time, and then how to protect those assets as well. So that was a very long, short story in a very short period.
Yeah, that's a great story. You were born in San Diego, right? And now you're based in Indiana. I assume you didn't play much hockey in San Diego, but you picked it up when you moved to Indiana.
Yeah, I did more surfing and boogie boarding and hanging out on the beach and things like that when I was in San Diego. In Indiana, I came to love hockey, and then I moved to Vermont for a while and watched a lot of hockey on, CBC and stuff like that. And in Vermont and obviously Canada, there's a deep love for hockey, and so as a teacher, I figured out how to. We didn't put on ice skates and stuff like that. We played like floor hockey, but all the same rules applied. And I would put kids in the box, which is like, if they did something wrong, they'd get put in the box for a while. And they always thought that was the worst, having to sit on the side for 2 minutes while everyone else got to play.
Yeah,
But
that's
it was
great.
good.
Yeah, it's a great team sport. I'm from Switzerland originally, right there. Other than soccer in the summer, hockey is a big team sports in the winter, right? And it's a rough sport, right? But it's a very good team sport that is very quick, and it teaches the kids a lot of ways of dealing with defeat and roughness too, right? And
Yeah.
I think that helps also for real estate investors, right? It's a rough and tumble world in a lot of instances, and I think it's always good to hear from others that are educating investors that are not institutional investors. I have
Yeah.
an institutional background, but a lot of our clients are also private investors or
Mhm.
syndicators. And that's a big part of our job too, just to educate them to make sure that they are aware of all the pitfalls that they may think are not there, or someone tells them, particularly coaching gurus tell them it's all easy going until
Right.
until they realize it's not that easy. Right.
Well, yeah, I love sports analogies in general. And I think with real estate, it absolutely applies. I mean, especially commercial real estate, right? From the base, it's a team sport. I think we all understand that without the team around us, without trusting the other people that are a part of our team, we don't get very far. If you want to play a single sport like tennis or something like that, you go out and invest in residential real estate. That is certainly more possible to do. But if you're going to be in multifamily or office or retail or wherever, I think it is a team sport. And then I think you're right. You have to learn how to lose sometimes, and you have to learn to get that repetition. I hear that over and over again. It's like you build your strategy, you understand where you're going, and then you get your licks in, you get your repetition, you get your swings in, whatever your metaphor is that works, whether it's a sports metaphor or something else. You're figuring out what those things are so you can A, learn to get better yourself, and B, learn to tell who the people that have red flags about them or who aren't doing it well, so that you don't ask them to join your team as a part of elevating the game. So I am a huge fan of sports analogy. I'm also a huge fan of European soccer. Champions League is in full effect right now.
Yeah.
And I think that hockey and soccer are great examples of team sports, as well as so many others that really do align with commercial real estate investing.
Yeah, definitely. Uh, it's as you mentioned, it's a team sport, right? And you assembling that team early on is absolutely crucial. And unfortunately, even though we are telling that our clients over and over and over, some of them are not listening until they are already under contract, and then they reach out to us for financing, and they realize that their underwriting was completely off.
Yeah.
And on the insurance side, it's the same thing, right? So then suddenly they realize, wait, I need insurance. And as you know, right, it takes some time to get commercial insurance quotes. This is not just a residential property where you get a quote within essentially a few minutes, right?
Right. Yeah, I think that the insurance side of that underwriting is one more line item, one more piece that understanding how it works is really, really important. And there are some just basic, simple things you can do. The most important one is, and this is true with so many things, establishing a relationship with someone that you trust to know what it is you're doing. Insurance, probably more than a lot of other worlds, has a lot of bad actor, not people who are purposefully bad actors, but people, and there certainly are those, but people who think they can do it and just can't. The reality is, like so many other spaces, you can make a lot of money insuring commercial real estate. And so someone who doesn't necessarily know what they're doing, if they're a friend of yours or someone you connected with them somehow, you say, hey, I've got a 144 unit multifamily complex on the coast of Louisiana that's a value add. It's got some deferred maintenance, but I think it's going to be cool. Can you insure it? Well, that person's thinking, boy, I could make $15,000 doing that. So what are they going to say? Well, they're going to say yes. And the reality is they should have said no, and you probably shouldn't have asked them in the first place. Like, it's like asking a lawyer who just got out of law school to write your lease for a large multifamily complex or a 10-year triple net lease on an office complex. Like, you're going to get what you signed up for, and that's not going to be a good thing. So the first thing I would say when it comes to real estate, when it comes to insurance, is find someone who knows what they're doing. And everything I say behind that sits underneath that basic premise, because when you ask a lawyer to write that lease, you don't go in there and write most of it and then say, hey, does this look pretty good? And then pay them, the $10,000. You expect them to succeed at doing that. When you talk to your accountant about money and connecting in that way, you expect them to have some skills in that. I think too often with insurance advisors, we just think it's easy, or it's not a big thing, or it's just a line item we have to deal with, and we just pick the closest person. And I think that's a huge mistake.
Yeah, it's an excellent point. We actually deal with the same situation, right? A lot of our clients ask initially, why should we use a commercial mortgage broker? I can go to a lender directly. Yes, technically you can. The question is, do you know what lender to reach out to, right?
Yep.
Which are the most appropriate lenders? And once you go on the loan application, who is actually helping you to get that deal closed without, as we call it, a retrade from a loan amount perspective, from an interest rate, interest only, and so on. So we have a similar situation where very often someone believes that they don't really need help when they really would greatly benefit from that help. We also have a lot of residential debt brokers that think, because the money, obviously, they
Yeah.
see you may make much more money on the commercial side, so they jump in and think that they can do it. But that lawyer analogy that you brought up is really important, right? So technically, yes, you can get quotes from lenders. That's easy, right?
Hmm.
Collecting quotes is terribly easy. However, the tough part is really to identify which quote is really realistic and which lender can you trust that they can perform, right? And
100%.
if you're not in that field for many years and you have done so many loans, you just don't know, right? And that lawyer element analogy that you brought up is really important, right? Because the the agreements are very often standard agreements, right? So one can argue, look, I can draft that for you, where the true value of a lawyer comes in is to tell you the risks that are associated with that lease agreement. And it's not really written in the agreement itself, right? So you need to be able to identify, have the interpretation of the risks, and hopefully add some wording there. And I think whether it's for us on the financing side or for you on the insurance side, that's really where the value comes in. That, yes, here is a policy, but let me tell you what the risks are, right? Because you have, particularly with insurance, you have so many pages, no one reads them,
Of
right?
course. Yeah.
But that fine print can have a significant impact, and if you do not really understand it, it's a problem. And if you think it's not a problem with a certain clause, you may have a big wake up call down the road, right?
Oh, absolutely. There's two things I thought of as you were describing our two industries and the way that we serve investors as a part of their team being so similar. And one of those similarities is the reality for, I think, both of us is finding a really good commercial real estate lender and finding a really good commercial real estate insurance advisor is likely going to end up being ultimately cheaper than going the other way. Now, it may not seem that way on the front end because we're putting together a quality product instead of a non-quality product that looks cheaper. But I think in both cases of ours, oftentimes a better advisor is actually going to save you money. So not only are they a better advisor, but they're cheaper in the end. It always amazes me that those two things can come together. Of course, that isn't always the case. It depends on the scenario.
Yeah.
But I just think that's so true. Like there are so many little details in loans. There's so many little details in contracts. There's so many little details in insurance, and no one expects investors to know all of that. And that's why building your team is such a key foundational piece of what you do as a successful commercial real estate investor, because every good leader has people they trust. And that's what I think you have to figure out.
Yeah, absolutely. So obviously COVID-19 is still on everyone's mind. Now we have essentially passed roughly 1 year in a lockdown environment, right? Depending on the state one lives in, the lockdown feels still like a real lockdown. And in some other states, like we are in Texas, it feels like almost being back to normal. Uh, so how did it work out for you and some of your clients over the last year, starting in March of 2020 when the whole world seemed to fall apart, and how did you and your clients deal with it?
I think for us, we were a virtual agency pretty well already. We had everything set up in that space. We obviously lost a ton of our physical interactions with our clients, with investors, with other insurance advice, with everybody. We just lost a lot of that physical interaction like everyone has. And that's coming back a little bit slowly. But I certainly miss that. Going to a conference and getting to see people that I haven't seen for a year since the last one, that was big for us. But as far as our business, we were very fortunate in the sense that not very big effect on our business structure itself. We were already basically built for this. the effect on our clients as a whole has been huge. I mean, we have insured restaurants, small business, things of that nature. We are focused on commercial real estate right now, which I'll get into in a second. So that was actually a blessing in a lot of ways. But a lot of our clients that we've had for years and years closed down or are struggling like so many other people. And so we've helped people navigate that. And I would say a large percentage of our small business clients have closed down, whether they reopen or things like that are still to be seen. But retail has struggled, no doubt, and hospitality as well. Seeing that come back a lot more, particularly the Airbnb space, VRBO, that kind of thing. But for real estate investors, I think the first big question, and this was a business as a whole, was around the coverage of loss of income. So insurance policies have coverage for lost income. So if you have a property and a building burns down and you are not able to make any money from that building anymore, you had a 16 units in there for a year, we're rebuilding it for you. And you can't make the $160,000, $170,000 that you would have made off of that property. Your insurance policy should have coverage built in to cover that lost income. So a lot of business owners, particularly Main Street businesses, asked, well, I lost income because of COVID. People can't come into my business anymore. They can't walk in anymore. The government has shut down. I had to close my doors. Does my insurance policy cover my lost income? Which was a great question. And the answer is no. The reason for that is that business income coverage, loss of income coverage, is directly related to a physical loss to your building. So if your building burns down, that is a physical loss to your building and loss of income would apply. If your building gets blown over by a tornado, that is a physical loss to your building and loss of income would apply. A pandemic does not apply. And so there was a lot of confusion about that early on. Of course, businesses hoping that their insurance policy would pay out for the lost income associated with COVID.
Sure.
And that just wasn't the case. There are some specific policies. Wimbledon was a great example. They had a policy that ultimately paid out, I think, $5 million or something like that. But those are specific, very expensive policies that no one really had.
Yeah.
So that was the biggest COVID thing early on.
Mm-hmm. Have you seen some carriers or some niche players now offering some type of insurance that will cover, obviously not COVID-19 because we already am, but kind of future events similar to a pandemic or some other events that are not physical loss related?
Yeah, I think we're going to see two things, and we're already seeing some of this. One is a more specific insurance product or a thing you can buy that specifically addresses lost income from this. My sense is the likelihood of price matching what you're willing to pay may not be very clear because it's just such a potentially large loss for insurance companies. I mean, had they had to pay for everyone's lost income, a bunch of insurance companies would have gone out of business. We would have had another problem. But I see those things starting to be created. The other thing I see is what insurance companies often do in these scenarios is more specifically exclude coverage for these things. So they say, well, my legal language wasn't quite strong enough, and so I want to make it stronger. And so you'll see new endorsements that actually more clearly say, hey, just to be clear, this is not covered. So I think we'll see both of those things.
Yeah. Okay. So now the exclusions grow and grow and grow, right? So
yeah, insurance policies, those 200 pages are basically the story of a 400-year history or whatever of insurance companies saying, we'll insure this, and someone saying, hey, well, does this get covered? And them saying, oh, well, that wasn't very clear, so we'll make another little clause that makes that particular situation clear, and back and forth and back and forth. So Mike, like most legal documents, insurance policies are a story, just a rather boring story to read.
Yeah, yeah. So obviously part is was driven by natural disasters that we have gone through over the last year or two.
Hmm.
We certainly have seen in a number of markets quite a bit of rise in insurance premium that's completely unrelated to the COVID-19. It's really natural disaster related. So do you see any pause to that, or any relief to that, or do you see that the premiums still are going up?
That's a great question. And there's no doubt that, particularly in the multifamily world, but I think across commercial real estate, we've seen increases over the last 3 years, some significant increases. An interesting stat: insurance companies have lost money on the multifamily asset class for 12 quarters in a row. We just completed another quarter. I don't know the answer to this one, so it could be 13. So, insurance companies are losing money on multifamily. And that's why in this asset class in particular, we've seen huge increases. Now, I'm doing a lot to navigate that, but that's a reality. I think in the last year, we've seen it stabilize a little bit more. I've seen it kind of sit, but also COVID was involved. So I think a lot of insurance companies are sort of sitting still to see what all is about to happen in the market so they can have a better sense of what they need to do around rate. And thankfully, I've seen on both residential and commercial side, insurance companies get a lot more flat for this last year. We'll see what they do in the next year. But there's no doubt that there's this relationship between natural disasters, between hail chasing roofers, which is always a back and forth between insurance companies and roofers. And obviously, in the multifamily space, roofs can be 3, 4, 500,000 dollars, millions of dollars in some scenarios. So that's a big piece. And then liability law is the other huge piece. I mean, Florida is really dealing with this, where the laws for litigation really lean towards the folks filing the lawsuits, and insurance companies are struggling with how big the losses are around those litigation claims. Now, who's right or wrong is not what we're here to talk about, but that is just the reality of the back and forth. So when you're losing millions of dollars in a claim where someone burned themselves or slipped on a staircase or whatever it is, that's maybe an extreme example, but um, insurance companies are in a position to increase premium. Now that, you look at CEOs of insurance companies, they're making plenty of money. So I'm not, crying for the insurance companies or anything like that, but that is the back and forth, right? They're trying to make a profit. And if they aren't making a profit, then they have to do something to do so. I'm
Sure.
seeing I'm seeing a lot of companies leave multifamily,
Yeah.
say we're not interested anymore. Companies like Guard, which is a Berkshire Hathaway company, they're still kind of doing it, but I'm seeing 30% rate increases on renewals for some of those policies. That's a company saying we don't want to do it anymore.
Yeah.
You know,
Yeah. Yeah.
we'll
And
insure it. We'll insure it if you'll take a 30% rate increase. What they're saying is we don't want to do it anymore.
sure.
And
Yeah.
so that's what we're navigating. But there's plenty of folks who do want to do it. And there's plenty, I mean, my book of business has an average increase annually between 5 and 10%. And there's a lot of things I do to make that happen. And I have the benefit of being pretty large in the Midwest,
Mm.
not places like Texas, Florida, or California, where it is a little bit harder. But I'm
Sure.
seeing some stabilization is the answer to your question, but I'm not sure where it's going to go.
Yeah. Okay. So where do you see the reason why they lose more money in multifamily than in any other commercial asset class? Is it because of the roof, primarily roof damage and liability claims? You would think solely on the retail side, you would have also a lot of liability risks. So what is the difference between these asset classes that multifamily is causing the largest impact on the negative side for these carriers?
When you have people living in a place, there's just many more opportunities for bad things to happen. I mean, the bottom line is the numbers are just different. That's the answer. When you look at office losses, they're much lower than when you look at multifamily losses. But the reason for that is habitational, people living in a space has much more repetition of human behavior, many more stoves, many more cars parking in places, many more human interactions and parties. And so you have more opportunities for bad things to happen, including fires, including liability claims. and all those kinds of things. So in general, this has been true across the history of insurance that, the more a space has activity, the more likely a claim is to happen, and therefore the more often claims happen in that particular asset class.
Yeah, that's a great point. Yeah, so you have essentially a high density environment for almost 24/7, right?
Yeah.
Yeah,
Yeah.
yeah,
Yeah. Office, most people go home. You've got 12 hours of the day where nothing's happening in that space, particularly. You don't have any stoves or very few stoves, the most risky part of the space. Now, you have people in and out, there's risk, but there's just a lot less.
yeah. Okay, very good. So when you look, I obviously you don't have a crystal ball, but what do you think is going to happen in the insurance space over the next year or two, due to COVID, but also because of the changes in the way everyone works and operates, building codes, and so on?
Yeah, I think we're going to stay a little bit more flat than we were in the past 2 years, but I think we are going to remain a hard market, which means, prices are going to continue to go up. I mean, prices don't go down, unfortunately. I don't know that there's ever been. Well, that's not true. In commercial real estate, there can be soft markets where you have companies then fighting for business. It's a supply and demand thing, right? If you have companies vying for business, then I have the ability as an agent to make those companies fight each other and inherently make the price go down for the exact same product. If fewer and fewer companies are vying for that same business, then those companies sticking around can increase their rate because they know that there's not as much supply. So even though it's not a physical thing that we're selling necessarily, it's a supply and demand all in the same. And right now we are in a low supply environment, and I don't expect that to change. I do like how price flattened a little bit. And I do think that as fewer and fewer companies are in there, companies are going to come back. They always do. At
Sure.
some point, they look and they say, look how low the supply is. I could be in that supply space. And so I'm going to come back.
Yeah,
And at
that's
that
a
point,
good point.
you start to get more, and then you start to see price, be able to get softer, which gives us the ability to fight them down and give our clients a better price.
Yeah,
So I certainly would underwrite for 10% increases a year. I think that's a very safe way to underwrite your properties and your deals. But I think that we can see some flattening there without the crystal ball that I described.
yeah. Okay, very good. So we saw only what you referred to. We also see in the lending space all the time. I would say right now it's probably particularly in the bridge loan space, right? A year ago, a big chunk of the bridge market disappeared virtually overnight, and it was a pretty limited environment one could find bridge loans. A lot of bridge lenders disappeared completely. Some of them stayed, but they were very picky. And now we are back to, I would say, where we were well before pre-COVID. We have very aggressive pricing. We have players coming back in and trying to beat each other, right? So obviously we don't have that situation on the insurance space in the insurance space right now, but you never know, right? You just
Yeah.
need someone who decides. I think the premiums are high enough that it's worthwhile to enter. It's
I think so. Yeah. And I think insurance is exactly like you just described. It's just slower. Everything about the way that things change in this industry are slower than the way that they play out in the mortgage industry. At least that's been my experience. I don't know if you agree with that.
yeah, definitely.
Yeah.
Uh, so you have grown your agency quite rapidly over the last 7 years or so. You also have a podcast, so you clearly have a marketing element to that you bring to the table to your agency. So can you give our listeners maybe a few tips of how they can position themselves to be more visible, right? Particularly as a real estate investor, visible to your brokers when you want to buy a property is pretty important. But also, particularly if you're a syndicator, you need to raise money at some point.
Mhm.
So, do you have some some snippets based on your interviews that you have done, and as well as your own experience, where you see that these are some marketing elements where it really that are kind of the more successful ones?
Absolutely. So I think that one of the things I started from the very beginning and remains true, although there's a lot more people doing this now, but is that when you decide what you're going to do, if you're going to be a sponsor, if you're going to be a passive investor, if you're going to be a joint, do a joint venture, whatever it is you're doing, and you start thinking about who the people you need to attract are, you need to define those people as clearly as possible. And if you look up ideal client avatar. There's lots of people with lots of opinions on how to develop this person, but you want to develop the people you're trying to attract down to almost like a single human. You give them a name, you talk about their personality, you know what they do for fun. The more you can zoom in on this person you're trying to attract and talk to them and the things that you do, the larger the community of people are going to attract to you. It's just inherently one of those things where if you just zoom in on one person, lots more people want to be a part of that. Whereas if you try to talk to everybody, it's too bland and no one's interested. So the first thing I would do is really refine who your ideal client is that you're trying to attract. If that's a type of broker, who is that type of broker? What kind of business are they doing? What kind of car do they drive? Really what market are they in, and start to refine that. Once you have an ideal client for whatever it is you're trying to do, then you've got to figure out how to do good things for them. And I don't think that has to do anything to do with your product or what you have. Obviously, in the work that we do around real estate, there's lots of things around real estate you can do to help people. But figure out a way to help them. So for me, the podcast was a great idea. My ideal client is a commercial real estate investor in multifamily, office, retail, or industrial with 50 or more units. And that is the person I'm trying to attract and connect with. I always also want them to be someone I like and would enjoy having a drink with or getting to know, and someone who's not just trying to make me quote business against 5 other agents to see who can bring them the cheapest, dirtiest quote. So that's my ideal client. So how can I help that person? Well, a podcast is a great way to do that. If I'm interviewing other people who have 100 units, who have 1,000 units, who have been investing in real estate, like Brian Burke for 20 years and have thousands of units, and ask them how they did it and how they succeeded and how they built their strategies underneath their successful journey, and I can provide that value to other people who are trying to go on the same journey, then that has nothing to do with insurance. And I'm not trying to make it about insurance. I am just trying to help those people. And inherently, they then turn around and see me as a thought leader as well. So for your listeners, you've realized the ideal client. Now, what is it that you can do for them? Podcasts are great. There's a lot of them out there, though. So, you've got to have one that makes a lot of sense. But it's a great example. You could have a clubhouse room. You could create have a way to underwrite deals. If you have a great underwriting system, a great pro forma that you use, share that with other people. There's lots of ways you can provide value to people. So start providing that value. And then the last thing I would say is you have to be consistent in whatever you're doing. If you've decided I'm going to comment on 10 LinkedIn posts a day of people that I look up to and want to be a part of, that's a great strategy. That's an awesome strategy that lots of people, Gary Vee and Yona Weiss and folks like that, suggest you use as a very simple way that you don't have to create your own content. You can just go out there and comment on other people's. You've got to do it every day. If you're going to create a podcast, you have got to decide, when am I going to put that out? I'm on episode 47. I've put it out every Tuesday for a year now. I've been podcasting for 5 years, but this particular podcast has been out for a year. So that is consistency. And what you'll build over time is a snowball that grows and grows and grows. And you start to connect with those people who you wanted to connect with, and your ideal clients become your friends, become a part of your team, and opportunities start presenting themselves. So it's just a matter of knowing who you're talking to, doing good things for those people, and being consistent in the good that you're doing.
Yeah, that's all great tips. What you mentioned earlier, right, with focusing on your avatar, I think that's it's very important. I think it's even important when it comes to your investment strategy, right? We see a lot of our clients, and particularly newcomers to the space, they are looking at everything, right? So they are subscribed to every single list that they can subscribe to from across the country, with every single listing on market, off market that is out there. And they ask me, what about this in Indiana? What about this in Phoenix? What about this in Florida? And they do not have a clue about any of these markets, but they still think that that might be a deal, right?
Yeah.
So they will never be able to really identify a true opportunity because they spread themselves way too thin. And I understand it's always that shiny object everyone is looking for, right?
Yeah.
But that focus on your clients, the focus on the markets, the focus on the properties that you are focusing on is really a crucial piece to be successful, right? You need to be an expert in something, and you cannot be an expert in everything.
No, and I mean, it leads to two things, especially in a saturated market like we have right now. I mean, if you're coming into commercial real estate for the first time, you have to understand there are a lot of people doing the exact same thing right now. And that doesn't mean you can't succeed. It does mean it's going to be harder to succeed. And especially if you're more spread out, it's going to be even harder to succeed. So if you focus on a market, or if you're a passive investor, you focus on finding the right syndicator, or if you're a sponsor, you say, I know Cleveland, Ohio, because I live in Cleveland, Ohio, or I know whatever market it is you're focusing on. You've inherently gotten rid of a ton of the other competitors that you have in your space. And I think that makes a ton of sense. And then the other thought is there's just burnout. In social media. I think Clubhouse, I don't know, Anton, if you're on a Clubhouse or not, and I love Clubhouse and I'm enjoying it. But I mean, it is a constant, especially with if you have, the reminders on your phone or whatever, it
Sure.
is constantly asking you to engage and be a part. And especially if you're spread thin, looking for markets all over the place in all different asset classes at all different values, it's just, you're going to burn out, and it's not where you're going to end up happy, and it's not where you're going to end up successful. And you're going to look back and wish you had had a better foundation, a stronger strategy, and more clarity.
Yeah, definitely. Right. And whether it's Clubhouse, whether it's Facebook, LinkedIn, whatever it is, it's also important to remember people always put their best story forward.
They
So,
do.
so don't
Yeah.
be upset, right? So that social media is a beautiful thing, but it also can be a curse when you feel that you are on the losing end, right? Everyone apparently is winning, but you are losing. When in reality, that's just part of marketing, right? So
Oh, it's part of business. It's part of being an entrepreneur. There, every single entrepreneur, successful, not whoever, is struggling 30% of their time at least. And many are struggling 80% of their time, I would say. But none of that is shown on the outside. I struggle at least 30% of my day.
sure.
Whether that's with, why don't I have a better strategy? Why haven't I trained this individual better than I did before? Why didn't I reach out to more people today like I said I was going to? Why didn't I reach that goal that I wanted to achieve and I believe? Why wasn't I as consistent as I thought I could have been? We all have doubts, we all have failures, and none of those are on social media.
That's right. Yeah.
you know
Yeah.
but that's just reality, and there's nothing wrong with that, because that is a part of learning. It's what you learn from those doubts, what you learn from those failures. You can't fit. There's lots of things. Failure isn't a bad word or whatever. That's how you learn.
Yeah, absolutely. You also mentioned, right, add value. Part of that is, I think, is also to connect people, right? Refer, and don't expect some return when you refer someone, right?
Yeah.
And if you cannot help, you refer. Then everyone is remembering that you referred someone, right? Without asking for anything. Yes, you didn't win, but down the road, I think you will still win, and you just created someone else. If the two individuals that connected when they were successful, they both remember that you helped them to be successful, right? So
Oh,
don't be
yeah.
greedy, right?
Oh my gosh, referrals are the glue of the real estate community. Real estate is a people business. We all know that. And referrals are the glue of that. And
Yeah,
so you get two things when you refer people. One is what you just said. They remember you as the person who brought them together. But then, you get that person who you ask them for a referral at some point, and they're going to give it to you. And I think as a service provider, there's just nothing better than a referral coming my direction, because there's already trust built. If someone was willing to say, hey, you should go check out Shine Insurance. Jeremy is awesome. They take care of us. They take care of our portfolio, and they do an amazing job. That person also already has some knowledge of who I am and what I am in a different way than if they just found me on Google or whatever. And so you're helping the person on the other end, you're helping the person who you referred, and you're helping yourself. Referrals are just such a beautiful thing.
yeah, yeah. It's a great point, right? Uh, so, Jeremy, you added great value today to our listeners. How can they reach you when they want to talk to you about your business, your podcast, marketing, whatever it might be, or hockey?
I'll always talk hockey. You can find me all over on social media. Just search my name. As far as the podcast, it is reiclarity.com. And then if you want to talk about insurance, I really feel like almost 80% of real estate investors have terrible insurance policies because of some of the things we talked about in this conversation. If you go to shineinsurance.com/REI, quick 3-minute quiz that kind of helps you to understand whether you're one of them. It's pretty simple, straightforward, but gives you a sense of if you have some of the things that you need to be properly set up. So yeah, those are the ways to find me. And Anton, I really appreciate being able to chat with your audience today.
Yeah. Thanks for being with us, Jeremy.